Welcome to TheoTrade. This is Don Kaufman here on September 14th, 2017, doing the Theo Night video. S&Ps today will finish, well, for the most part, massively unchanged. Nasdaq futures a bit weaker by about 0.6% after really unleashing some incredible strength in a few recent trading sessions. It's one of the first days we've actually backed off, obviously, on the week. Nevertheless, let's get right to a trade idea that I want to kind of bring into focus right now, specifically inside of the IWM. Now, a lot of people start their search for trades here on the charts and ultimately trying to assess what they think the next move is ultimately going to be. However, I look at this business very, very differently. I look at a number of major factors, one of those including implied volatility and what we term skew, which I'm going to bring up here momentarily. Now, if you do start your search on the charts, what's imperative to know before you even go into the chart is the product liquid enough to support any given trade? And that's not found per se here on the charts. It's not about just volume. And this could be a stock trade. This could be an options trade. It could be a futures trade. But, you know, before I really consider doing any trade, I close up everything in the options. I look at the underlying. Sure, I look over at the volume. I'll cruise down to like options statistics here on thinkorswim. You know, is it trading any contract size in terms of the options? Clearly, IWM is, all right, it's there in volume. It's got 14 million shares. It's doing almost 300,000 contracts. Then I'll cruise over. If I'm really considering an options trade, I'll cruise over. I'll go about, 30 days out, and I'll start to dig in and look at things like bid offer spreads, which is a penny or 2 penny wide market. Okay. So then I can proceed over here. And again, a lot of people kind of start their search in the charts. A number of different studies. Well, I'm going to bring up the TheoTrade RSI Laguerre, which is actually displaying, the IWM, which is of course the ETF for the Russell, in heavily overbought territory. Now, I'm not the market technician, but I'm just going to explain this for a second and then move on to what I personally would look at. But here we are in overbought territory. If you're into fractal energy, this is the fractal energy right down here. The fractal energy ultimately relinquishing that this move could possibly be over. A lot of the energy, if you will, has come out of the move. That's kind of what fractal energy is. Now, again, I'm not a big market technician. I'm not necessarily into that. What I will look at is how wild this move is in terms of either number one, percentages, or number two, if you just look point for point. Over the last about month, we've moved literally from 134 in the IWM to, roughly speaking, where it currently is about 142. So if you just want to round it in here, here's the move. It's about $8. Right, is an $8 move in less than, and again, if you take a look at this, this is less than 30 days, and considerably less than 30 trading days out there, right? So why am I assessing from low to high? So we've had a straight shot about an $8 move. So now I'll go over to the trade tab, and inside of the trade tab, you look out about a month. I'm just going to open up the 29-day options here to make an important point. So I'll open up these 29-day options, and then I'll look to the far right-hand side of the screen. And what this is the expected move. It's what the option markets is depicting risk to be. It's what the option markets is displaying the move is likely to be in the next 30 days, right? I wanted to come right around 30 days just to be able to make a point, because that's what we were just looking at. Now, normally, we should only move about $4 or $4.20. But as we just saw on the chart, we've moved about $8. And that's when I start turning around and going, there could be a trade opportunity in here, because this is what we kind of call a 2 sigma move. It's 2 times, the expected move. And the expected move is considered 1 standard deviation, or what some people will call 1 sigma. So therein lies a trade idea when you start looking at this. And again, from I think, a different perspective. I'm looking at this much more from like statistical analysis than I am. Some people will bring up, an RSI Laguerre. Some people will bring up a MACD, a Fibonacci. Listen, whatever does it for you, right? But I prefer to base this stuff on statistical analysis. Now, I'm ready to build a trade, okay? Now, you can build bullish trades, you can build bearish trades, but the next step of this is I want to make an argument for reasoning of why in a lot of different trades that you do right now, okay, it actually will pay and be much easier, more effective to be able to place some bearish trades. And I'm going to go a little bit further out in time. I'll go out to the 36 day, and you can see I've already positioned myself in here, and I'm going to show you the trade that I've been routing today. It's going about 92 cents, and I'm going to go ahead and route another one over here. So I'm waiting. Maybe I fill, maybe I don't. Filled! So we filled another one. And by the way, I don't mind ever. Like, people get all crazy about, oh, he's routing one contract trades over here. Look at this one. I got the other one at 92 cents. Maybe I can work this one at 90 cents. All right, there's only seconds left in the trading day. Ooh, filled even at 91 cents. All right, so now I've gone through and I've placed a trade. I'm actually going to talk to you a little bit about the trade because I think this stuff is important. All right, you can place bullish trades, you can place bearish trades, but there is one critically important lesson that I got to drill home to you, okay? And that is, in today's marketplace, in most of the products you're going to trade, whether it's Apple, okay, whether it's Tesla, there's the closing bell, whether it's Apple, whether it's Tesla, whether it's IWM, whether it's the spiders, whether it's the QQQ, okay, whether it's Google, whether it's Amazon, the bearish trades have tendency to price substantially better than the bullish trades. Now, allow me to take you through this a little bit. Here's an underlying that's trading at 141.85. Now, I'm going to build what we term an in-out spread. It's about one strike in the money, one strike out of the money, okay? Now, let me lock this trade down. This is a bullish spread where I'm buying the 141 calls and I'm selling the 143 calls, okay? In this trade, it would cost me about $1.12 to buy a $2 wide spread. And this is a $2 wide spread purchased for about $1.12. Now, one of the points that I want to make is if you take a look at what's termed the intrinsic value, that's the real value of the 141 calls, okay? And those 141 calls, there they are, right there. And their intrinsic value is about 86 cents. That's the real value. That's excluding all time value. Well, the intrinsic value of these is about 86 cents, but the spread's going to cost me about $1.12. Now, let's look, okay, at a put spread. And a very, very similar put spread. In this case, I'm going to do the spread that I just purchased. I'm going to come up here to buy, and I'm going to go down to vertical, and I'm going to make it a 143, okay, 141 put spread. Now I'm going to lock the price here. Now this is two different trades. Now you would never do both trades. One of them is bullish, all right? So let me clarify and draw in here. So the trade on top is our bull trade. Trade on the bottom here, okay, is the bear trade. Why is the bear trade trading for 90 cents, the bullish trade trading for $1.12? Is the marketplace saying I'm going to go up more? Okay. Is the marketplace saying I'm going to go down more? Like, why are these things priced? And you have to recognize vastly different, right? So here is a bearish trade trading for 90 cents. The bullish trade is going for $1.12. And you're like, okay, so what? It's, 20, 22 cents difference. Yes, but if you look at the intrinsic or real value of the 143 puts, the 143 puts are trading for almost $1.15, okay? Those puts, the puts are $1, almost 14 in the money, and yet you can buy the whole spread for 90 cents, okay? What's going on here? Why is the put spread, okay, upwards of 20% less? And this stuff really adds up. If you go out and you just blindly start buying bullish trades, you don't realize that the marketplace is getting an edge over you. Why does this occur? It has to do with skew. okay, you're buying the 143s. The 143s have about an 11% implied volatility. And you're selling the 141s, which have a 12 vol. Now, that doesn't seem like much. You're splitting hairs, okay, over what? Right now, it's about 0.9%, right? The differential between 12% and 11% is about 0.9%. Clearly, though, that's big. If you looked at an $11 stock and a $12 stock, obviously on a percentage basis, a pretty big difference. But when you buy, okay, when you buy a call spread, the opposing is true. When you buy a call spread, you're buying an 11.2 volatility and selling a 10.2 volatility. Then the vol skew is against you. So one of the reasons, I get a lot of emails and people are like, why do you prefer bearish trades? I don't necessarily prefer bearish trades. I'm bearish in the overall market right now, but I don't necessarily prefer bearish trades. What I prefer is a skew in my favor. What I prefer is buying an option for an 11.2 vol and selling a 12 vol. The setup is the setup. Who cares? Never let the chart dictate the trade. Yes, I see a 2 sigma move. Yes, I see an overbought RSI Laguerre. Yes, I see fractal energy low. That is not going to influence, okay, a smart and tactical trade. In this particular case, I'm buying the 143, 141 puts and this is actually purchasing the put spread. And yes, I'm purchasing the put spread right around 90 cents for the next 36 days. Where do I need the underlying to do? I need it to go down. Massively? No, not massively. Okay, it's a defined risk spread. I'm going to try to make about 55% on about the 90 cents of risk I have. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.